Welcome to a new deep dive, where we cut through the noise and zero in on what truly matters. Today, we're taking a closer look at the latest financial results from Tata Consultancy Services, TCS, for their first quarter of fiscal year 2026. Our sources for this deep dive are their official press release and, importantly, the full transcript from their recent Q1 earnings conference call that just happened on July 10th, 2025. So our mission today is really to navigate the numbers, the management commentary, and, the key deals to give you a clear picture of how a global tech giant like PCS is adapting to the current economic climate.
And what's particularly interesting here, I think, is that even with all this global economic uncertainty swirling around, you can actually see clear pockets of growth and some significant strategic shifts starting to emerge. So we'll explore not just what the numbers are, but what they really signify for the wider tech industry and maybe how large companies are rethinking their tech investments right now.
Okay, sounds good. Let's unpack this. So let's begin by setting the stage. The headline figures for TCS's Q1 FY26. What do those top-line numbers tell us, sort of overall, about the performance?
Right. So the revenue for this quarter came in at 63,437 crores. Now, while that is a 1.3% increase year on year in rupee terms,
Okay.
the figure that's probably more telling is the constant currency one. It actually represents a decline of 3.1% year on year.
Oh, okay, a decline.
Yes. And sequentially, so compared to the last quarter, revenue declined by 3.3%. So this immediate drop in constant currency revenue, it really prompts the question, what's driving this contraction? Why are things slowing down?
Yeah, exactly. And that's where it gets particularly insightful, looking at what management said. They directly attributed this demand contraction to the ongoing global macroeconomic and geopolitical uncertainties. No big surprise there, maybe.
Right, the usual suspects.
But they specifically highlighted a trend of delays in decision-making and projects being put on hold, especially for what they call discretionary investments. They use this phrase, the bar on ROI goes up, meaning clients are just demanding much clearer, quicker financial returns before they sign off on anything new.
Yeah, that makes sense. And if we connect this to the broader landscape, it strongly suggests that while, the underlying need for tech is still definitely there, clients are just being extremely cautious. They're demanding very clear, immediate, and crucially demonstrable returns on their tech spending. So it isn't just about being careful anymore. It feels like a fundamental shift away from maybe those big aspirational transformation projects towards more pragmatic, efficiency-focused gains.
So less blue sky thinking and more, show me the money now.
Pretty much, yeah. Companies aren't just asking, can we do it? They're asking, how quickly will this pay for itself? And that's a tougher question.
Right. But you mentioned it wasn't all headwinds for TCS. What about their profitability, their cash flow during this, pretty challenging period?
Absolutely. Yeah, despite the top-line challenges, TCS showed some really strong operational discipline. Their operating margin, for example, it actually expanded by 30 basis points. That's 0.3% over the previous quarter. So Q4 FY25, it reached 24.5%.
Okay.
And the net margin also improved quite a bit, up to 20.1%. That's up 90 basis points year on year, which translated into net income of 12,760 crores, up 6% year on year.
Wow. Okay, so profits are up despite revenue being down in real terms.
Exactly. And furthermore, their cash from operations was remarkably strong. They achieved 100.3% conversion of net profit. That totaled 12,804 crores. So this robust cash generation, it really positions them very well to navigate, these ongoing uncertainties.
That margin improvement is definitely impressive given the revenue situation. What does it tell us about how they're running the business, and what were the kind of key drivers behind that profitability boost?
Well, the CFO pointed to two main factors. First, a reduction in third-party expenses, which speaks directly to their operational efficiencies, managing costs tightly.
Right.
Second, they did get some help from favorable currency fluctuations. And additionally, their other income saw a significant jump, but that was partly due to a one-time gain. About 600 crores from interest on income tax refunds.
Ah, okay. A bit of a one-off then.
Yeah, so while some of it was a one-off boost, it still highlights their, smart financial management and their ability to find efficiencies even when revenue growth is constrained.
Okay, let's shift focus a bit. Where are they seeing growth, particularly in these newer service lines? It feels like this is where the future focus is for them, right?
Indeed. Yeah, even with the overall demand slowdown, these new service lines like AI and data, TCS Interactive, and cybersecurity were clearly the growth leaders. The COO specifically emphasized a significant market shift. He said it's moving away from just exploring AI use cases.
Kind of playing around with it.
Exactly. Towards a much more focused ROI-led scaling of AI solutions across enterprises. So clients aren't just dabbling anymore, they're looking for real, tangible returns from AI.
And what kind of specific investments are we talking about in AI? What makes their approach maybe stand out?
Well, they're investing pretty heavily across the whole AI ecosystem. That means infrastructure, data platforms, AI agents, business applications, the lot. They mentioned strong traction for their own AI solutions, like TCS Wisdom Next, that's their AI insights platform, and Sovereign in Cloud, which is about secure, localized cloud stuff.
Okay.
But what's really striking, and it feels like a strategic bet on future demand, is their commitment to talent. They flagged that 114,000 of their associates now have higher order AI skills.
114,000. Wow.
Yeah, they believe this is one of the highest numbers of AI skilled people in the whole industry. That gives them a pretty significant competitive edge, you'd think.
You mentioned AI agents and also agentic AI. That sounds like something we could dive into itself. Can you give us a clearer picture of what is agentic AI and why is it popping up in client conversations so much now?
Yeah, it's a fairly new term, really gaining serious traction in maybe just the last, say, 6 to 8 months. But they said it's now part of almost every client conversation they have.
Really?
Yeah, basically, it's about creating intelligent systems that are more self-directed. They can not only automate tasks, like RPA, but also make decisions, learn, and adapt. It enhances accuracy and efficiency way beyond traditional automation. TCS sees big opportunities here, building industry-specific solutions, say, for banking and finance or manufacturing, and also just fundamentally transforming business process services.
So empowering systems to take more initiative, essentially, more autonomy.
Exactly. That's a good way to put it. More autonomy, more intelligence baked in.
Okay. So despite this current slowdown in some areas, the order book that gives us a crucial glimpse into future revenue, right? It signals what's actually in the pipeline.
Precisely. Yeah. The order book is key here. For the quarter, it stood at a really robust $9.4 billion.
9.4 billion.
Yep, and that's up 13.2% year on year. So strong growth there. If you break it down, North America contributed $4.4 billion, BFSI $2.5 billion, and the consumer business $1.6 billion. So this strong pipeline, even with project delays happening, is a powerful signal of, pent-up demand and significant future growth potential once things loosen up.
Right.
Management actually said they're comfortable with a $7 to $9 billion TCV total contract value number per quarter, and this $9.4 billion clearly beats that.
So it tells us projects might be paused, but they're definitely not being canceled wholesale.
Exactly. The demand is still there, just waiting.
Okay, let's look at the geographic breakdown. Where do they feel most impact from this cautious spending environment? And conversely, were there any surprising bright spots?
Right. So on a sequential basis, quarter-on-quarter North America was basically flat, just 0.1% growth. But year-on-year in constant currency, it was down 2.7%. The UK declined by 0.3% sequentially, and continental Europe was down 3.1%. But the most significant sequential drop was actually in India, down a massive 32.6%.
Wow, 32%. Why such a huge drop there?
Yeah, it was primarily due to the winding down of a large contract they had with BSNL, the state-owned telecom company.
Ah, okay. One big contract ending. So how does a company like TCS plan to counterbalance that kind of substantial local hit?
Well, they sound pretty confident that international revenue in this fiscal year, FY26, will perform better than it did last year, FY25, so that growth outside India should help offset the domestic impact.
Makes sense.
They also made an interesting point that the experience they gained from that complex BSNL project has actually given them new capabilities they can now offer to other markets globally. And crucially, they flagged strong growth in emerging geographies. Places like the ASEAN countries, Singapore, Malaysia, Philippines, Indonesia, and also the Middle East and Africa, MEA, and Latin America.
So new engines of growth, potentially.
Exactly. These seem to be proving key drivers for new business right now.
And how did their different industry segments fare? It sounds like, some were hit harder than others. Bit of a mixed picture.
Definitely a mixed bag. On a sequential basis, technology and services actually grew 1.1%, and manufacturing grew slightly, 0.2%, so with some resilience there.
Okay.
However, we saw declines across several key sectors: BFSI banking, financial services, insurance that declined 0.5%, consumer business down 2.2%, life sciences and healthcare down 1.2%, communication media was down 3.1%, and energy resources and utilities took the biggest hit sequentially, down 6%.
It sounds like BFSI and consumer business are struggling a bit overall. But then The report also notes that TCS and CS, their banking platform and BFSI products, are still growing.
That's right.
So that suggests a pretty complex internal dynamic, doesn't it? Where specific product lines or maybe niche offerings can still thrive even when the broader sector is facing headwinds.
Absolutely. It shows that even within a struggling vertical, targeted solutions or platforms can still find demand, especially if they drive efficiency or solve a specific pain point.
Okay, let's turn to their client relationships and their workforce. We often hear about client retention being a key metric for stability, especially in services. What did the report say about the health of their client base?
Well, it was slightly nuanced. They did see a small decline just by one customer in their top bracket, the more than $100 million revenue band. That number is now 62.
Okay, just one.
Yeah. But importantly, they had solid additions of clients in the next tiers down the $10 million, $5 million, and $1 million revenue bands. Their overall base of client spending over $1 million actually increased by 26, bringing the total to 1,336 clients.
That's interesting. So it's not necessarily that the big clients are leaving entirely, but maybe just their spending has dipped slightly, pushing them below that $100 million threshold for now, reflecting that caution we talked about?
Exactly. That's precisely how the company explained it. Clients aren't necessarily terminating relationships. It's more that the overall revenue degrowth, that pullback in discretionary spend, can cause some of those accounts that were maybe just over the $50 million or $100 million mark to temporarily fall into a lower band.
Right, makes sense. It reflects the broader trend. Okay. And on the talent front, which is obviously so critical for a services company like TCS, what's happening with their workforce numbers and attrition?
Well, their net employee count actually increased slightly by 590 associates since the previous quarter, Q4 FY25. So they ended Q1 with 613,069 employees.
Still growing headcount then, albeit slowly.
Yes. However, their IT services attrition rate, looking at the last 12 months, stood at 13.8%. The Chief Human Resources Officer, the CHRO, acknowledged this is, quote, a little more than our comfort level. Their ideal range is typically 11–13%.
So attrition is a bit high for their liking.
Yeah. They said they're actively working on employee engagement initiatives to try and bring that number down closer to their target range.
And any news on wage hikes for all those employees? Is that happening this year?
Not yet. The company stated they haven't made any final decisions on wage hikes for this year yet. They said they'll decide sometime during the year.
Sounds like a cautious approach there, too. Maybe waiting to see how demand shapes up.
Seems likely, yes. Given the overall demand environment, holding off on that decision makes sense.
Okay, so this deep dive wouldn't really be complete without touching on their future outlook. What's the sort of long-term vision and strategy they're painting amidst these current challenges?
Well, the management sounds, reasonably optimistic about international revenue for the full fiscal year FY26. They're largely basing that on the strength of that $9.4 billion order book we discussed, and also the ongoing customer conversations they're having, which seem to indicate a pipeline that's ready to convert when conditions improve a bit.
Right, the pent-up demand.
Exactly. They also firmly maintain their long-term operating margin goal or aspiration, which is 26–28%.
Even with current pressures.
Yes, even despite the current investments they're making to capture demand, especially in areas like AI. That suggests they see a path back to higher margins down the road. They also mention being open to M&A, merger and acquisition opportunities, but only if they are, in their words, value accretive to shareholders, customers, and other stakeholders.
So strategic buys, not just buying for growth's sake.
Precisely. They see potential M&A as a way to maybe gain access to specific talent, new technology, or even key clients in certain areas.
And what about their overarching philosophy? How they think about their earnings and where they choose to invest their money?
Yeah, they have a remarkably consistent and, I'd say, pragmatic philosophy there. Basically, if there's a good opportunity to invest, whether it's an R&D, talent, M&A, to increase shareholder returns in the long run, they'll do it. But if not, they're committed to returning a very high percentage, 80–100% of their free cash flow, back to shareholders through dividends or buybacks.
Okay, so disciplined capital allocation, balancing growth investment with direct returns.
Exactly. It highlights a very shareholder-friendly approach, especially in a dynamic or uncertain environment like this.
So putting it all together then, what does this all mean for you, the listener, trying to make sense of this complex tech services landscape right now? What's the big takeaway?
Well, I think what clearly stands out from this deep dive into TCS's results is their resilience. Despite these significant macroeconomic headwinds that are clearly impacting their revenue growth, They've shown remarkable strength in profitability and, crucially, in that order, book growth.
Hmm.
It tells us that while, yes, global companies are being cautious with their discretionary spending, they are still making strategic ROI-driven investments, particularly in critical areas like AI and cloud modernization. So this isn't just a temporary blip, I don't think. It signals a more fundamental, ongoing shift in where tech budgets are being allocated. The focus is intensely on demonstrable efficiency and real transformative outcomes now.
Yeah, it's really fascinating to observe how a company of this sheer scale can remain so agile, relatively speaking, and lean on its core strengths, like that deep AI expertise they're building and their strong client relationships, even when navigating such a challenging market. So, as you continue your own deep dive into what makes the business world tick, maybe ponder this. Beyond the current economic cycle, what will be the next major catalyst? What's the thing that truly shifts global discretionary spending patterns back into high gear? Something to think about. Join us next time for another deep dive into the source that matter.